Hey everyone, my name is Darren and I'm a resident at McMaster University. In my last video, I talked about how the interest rate on your medical student line of credit is lower than historical stock market returns over the long term. So for those of you that have ever considered borrowing to invest, today I'm going to talk about all the potential risks associated with doing so and the potential rewards. If you've ever wondered where the conventional wisdom that the stock market returns between 7 to 10% a year on average comes from, then you're definitely not alone. Finance is more of an art than a science in that we can never say with 100% certainty what the future is going to look like, and in fact the SEC is so clear on this concept that it legally requires mutual funds to tell their investors that past performance is not a guarantee of future results. That being said, even though we don't have a randomized controlled trial in the world of finance, we do still have data from almost 100 years of stock market history to inform us about what the likely outcome of current day actions is going to yield in terms of future returns. To understand the data that I'm about to present, it'll be useful to go over a few basic definitions. A stock, of course, represents part ownership in a company. An index is a collection of companies designed to measure the weighted average return of a given stock market, and the S&P 500 index is an index of the 500 largest companies in the United States. One way to look at stock market data is to ask the question of how often previous investors had experienced a positive return. Of course, this graph is examining returns specifically from investors in the S&P 500 index, so of course everything I'm about to say refers to the returns of those types of investors specifically, not necessarily investors in specific stocks or other indices. Of course, if we look at this data, we see a clear relationship that from 1926 to 2017, the longer an investor had held on to their investment, the higher the likelihood they would have had of receiving a positive return. Specifically, if we look at 10-year rolling periods between 1926 and 2017, 94.7% of these periods returned a positive result for investors. And finally, when we step that period length up to 16 years, so 16-year periods between 1926 and 2017, 100% of investors received a positive result if they had held on to their investment once again in the S&P 500 index for a period of 16 years. Okay, so clearly based on previous data, it does appear that an investor that is in it for the long term, willing to hold for more than 10 or 15 years, is likely to experience a positive result. However, given that we're dealing with the world of leveraged investing, just having a positive return is not enough because of course the profits that we expect need to offset the interest cost associated with our lines of credit, which today is sitting at around 3%. Another way to look at the data is to ask yourselves the question of what the average annualized return was over these previous 10-year rolling periods. That, of course, is what this figure is attempting to show. So if you'll look at the x-axis, you'll see that each point represents a 10-year rolling period between 1928 and 2019, and the y-axis depicts the average annualized return for that respective 10-year rolling period. Now, if we look, for example, at the far right of the graph, just to get our brains wrapped around this type of presentation, because I know it's not too common in the world of medicine. If we look at the far right of the graph, we can see that the 10-year rolling period from 2010 to 2019 returned an average annualized return of 13.55%. Now, of course, this is positive, but what we care about is the average of averages per se. And so when we look at the overall average return of these 10-year rolling periods, we can see that the average annualized return of these previous 10-year rolling periods is around 10.32%, which of course is where the conventional wisdom that the stock market returns between 7 to 10% a year on average tends to come from. Of course, previous average returns don't capture the myriad of future possibilities that could happen with the stock market, and even if we look at the data that we have in front of us, there are definitely 10-year rolling periods that have have returned less than 3%, or 10-year rolling periods that have even just flat out been negative. This, of course, is the risk that we take on with investing, in that even though we do expect to be compensated in the long term, there is a very real possibility of realizing a neutral or even negative return. The other caveat I would add when looking at this data is that even though it does a good job of depicting long-term outcomes of remaining invested in the stock market for periods of 10 years or more, it does not describe the day-to-day, week-to-week, month-to-month, or even year-to-year fluctuations in the stock market. If we think back even just recently to the beginning of the COVID-19 pandemic, the stock market did actually drop close to 30% in a matter of days. So that is definitely a risk you're taking on with the stock market, in that if you choose to invest, be ready for a bit of a roller coaster. Your portfolio can fluctuate up and down and up and down. But that being said, the previous data that we have seems to suggest that riding out those ups and downs will eventually result in you being compensated in the long term. Okay, so now that we understand the risks associated with investing more generally, as well as the potential rewards, the next question becomes, should one invest actively or passively? An active investor, quite simply, is an investor that either picks stocks individually themselves or pays someone to do so, usually through an actively managed mutual fund. A passive investor is an investor that chooses not to pick specific stocks, but generally accepts the average return of the stock market, usually by owning one or multiple exchange-traded index funds that they can buy that gives them exposure to every public stock in the global economy. While it may seem that active investing is better than passive investing because active investors can choose the good stocks and weed out all the bad stocks, there's actually a ton of research to suggest that passive investors do better than active investors more than 90% of the time, even when those active investors are professional money managers. I know it sounds crazy, but just let me show you the data and you guys can draw your own conclusions for yourself. Actively managed funds are typically grouped according to the types of stocks they buy and compared to an index that carries a similar risk profile. What you're looking at here is the S&P Indices versus Active Management Report for 2020, and of course there is a clear pattern here in that over the long term, actively managed funds underperform their benchmark index more than 90% of the time. Of course, these studies are conducted on professional money managers, so the chances that people like you or I would be able to come up with good stock picks is probably even lower. That being said, if you just walk into a bank, the reps will probably be really eager to sign you up for their actively managed mutual funds, and unfortunately I do think that's because they are financially incentivized to do so, because each one of those actively managed mutual funds comes with a high fee that of course keeps their fund operational and pays the salaries of those actively managed mutual fund advisors as well as their support staff. That being said, I think the probability of finding an actively managed fund that will beat the market over the long term is extremely low. And so I have chosen to go the passive route myself, along with the majority of physicians, and of course these decisions are based in the evidence that I've presented to you guys so far. Now, if that isn't enough to convince you that passive investing is the way to go, let's look at what the most successful active investor in the world has to say about this debate. Warren Buffett, who at the time of filming this video is the 5th richest person in the world, wrote the following in his 2013 annual letter to shareholders, and I quote, "Nevertheless, both individuals and institutions will constantly be urged to be active by those who profit from giving advice or effecting transactions. The resulting frictional costs can be huge and, for investors in aggregate, devoid of benefit. My money, I should add, is where my mouth is. What I advise here is essentially identical to certain instructions I've laid out in my will. My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. Based on the data, I think it's quite clear that passive index fund investments are the way to go, and in practicality, this does actually end up being the way that most doctors choose to invest their money. Typically, an investor will choose a set allocation of stocks and bonds, with a higher allocation of stocks being considered more risky, as stocks typically experience wider price fluctuations than bonds do. That being said, because risk is rewarded in the financial markets, a higher allocation to stocks also comes with a higher predicted future return. I assume if you're interested in leveraged investing, you either have a long time horizon or a very high risk tolerance, and possibly even both. In my mind, it doesn't make a whole lot of sense to use borrowed money to purchase a bond containing index funds, because the bonds in those funds have a return that is basically the same as our line of credit today, which essentially means that you're taking on a whole bunch of risk for no additional added benefit. To get the 7 to 10% predicted average annual returns of the stock market, you'll need to be invested in an all-stock portfolio. But if that sounds too risky for your own personal risk tolerance, there's nothing wrong with choosing not to invest your line of credit. If you do feel you have the risk tolerance and time horizon to invest in an all-stock portfolio, two of the most common and trustworthy providers on the market are Vanguard and iShares. Vanguard's global all-stock portfolio goes by the ticker VEQT, and iShares' global all-stock portfolio goes by the ticker XEQT. Both of these funds have basically the exact same composition, so it really doesn't matter which fund you choose. Now, I personally don't use these all-in-one fund solutions because I prefer to save on management fees by buying the regional index funds that make up these larger global funds. If you're interested in which index funds I use in my personal portfolio, I'll leave a link to my email newsletter in the description box below, where you will have full access to my own personal portfolio. Generally speaking, in Canada, you have both registered and non-registered accounts. The broad differences between these two categories are that registered accounts typically come with a contribution limit. However, all of your profits in this account are tax-free. In contrast, non-registered accounts are basically the exact opposite, in that there's no contribution limit, but of course you do have to pay taxes on any profits that you make. Where a non-registered account can actually come in handy specifically for leveraged investing is that if you choose to leverage, so if you choose to take money from your line of credit and invest it in a non-registered account, you can actually claim the interest that you pay for the portion of your line of credit that goes into that investment as an expense and deduct that from your gross income on line 22100 of your federal tax return. That being said, for most people, I still think it makes sense to max out their registered accounts first, because the tax benefits of essentially being able to pay no tax on any of your profits is likely going to outweigh the benefit of the ability to deduct the interest expense from your gross income. In the majority of cases, the TFSA or tax-free savings account is likely the type of account that you'll want to max out first, because like its name suggests, all the profits that you make in this type of account are completely tax-free, and unlike an RRSP, which is the other type of registered account that you may be familiar with, you can withdraw from a TFSA at any point in time, whereas in a retirement account like an RRSP, you of course have to wait until retirement to withdraw from it, otherwise you'll have to pay significant penalties. If you've never contributed towards a TFSA before, the amount that you can contribute will depend on the year that you first turned 18. Every year the government gives a specific allowance for individuals aged 18 years or older that they are allowed to contribute towards their TFSA. and so you'll be able to find that number that is specific to you on your CRA My Account profile. I will note, however, that the government doesn't keep track of the current year's contributions until it's accounted for in the next year when you file your taxes. So if you've contributed towards a TFSA of any kind this year, the number you see on your My Account profile will have to be reduced by the amount of contributions that you have contributed this year. The four main risks associated with this type of leveraged investing are market risk, behavioral risk, loan call risk, and interest rate risk. Market risk, of course, refers to the fluctuations in your portfolio, either giving you an unrealized gain or an unrealized loss. Of course, market risk is what's primarily responsible for your 7 to 10% a year on average that we expect from the stock market. However, again, in the short term, very difficult to know what's going to happen. So if you choose to sell at a loss, so if the market temporarily goes down and you choose to sell, there's a very real risk that the market can cause you to lose money. Behavioral risk then is intricately intertwined with market risk, and in fact I prefer to understand these two concepts together because behavioral risk refers to the investor's decision to either buy, sell, or hold. For example, if the market does tank and go down and you sell at a loss, that's the combination of market and behavioral risk coming together to give you a negative outcome. It's really easy to say right now when you're listening to the video that you're just going to ride it out because you know in the long term you'll get your 7 to 10% a year on average. But when you actually see your portfolio drop 20, 30, 40% in a matter of days, then it is a lot more difficult to actually do in practice because the emotional toll of losing money will make you feel like you need to protect what you still have, even if you know logically in the long term you're likely to come out ahead by just riding out the downturn. I don't think this point can be emphasized enough because once you commit to this type of investing, you're likely committing for 10 plus years, maybe even longer, and ideally until retirement. Life expenses do come up, like buying a car, buying a house, getting married, and if you are counting on this money that you're investing to fund those life expenses that you foresee coming in the next 2, 3, 4, 5 years, then that is not a great strategy because the market could have a downturn in the next couple of years and you would be forced to sell your investments at a loss, which ideally no one wants to do. Loan call risk is very specific to this type of leveraged investing. In traditional leveraged investing, the money that you borrow is collateralized by stock that you paid for in cash. So say your investment falls by a specific amount, say 50%, the brokerage would then just sell off the remaining stock in your account to essentially pay off the loan. Now, medical student lines of credits are different because they're actually uncollateralized, which means that the bank can technically choose to call back the loan at any point in time. All they have to do is say they want their money back. Now, in my knowledge, this hasn't actually happened in recent years, and I do think it's not the most likely of outcomes considering how widely advertised these lines of credits are and how often they're being used by medical students to actually fund their education. That being said, it is a real risk to be aware of, and if you call the bank, they'll probably tell you that the most likely situation that results in a loan call would be a medical student or resident dropping out of their program. Again, very important to be aware that loan call risk is a very real risk because God forbid if you were to actually invest a portion of your line of credit, then for whatever reason have to drop out of medical school or residency, the bank would 100% call back that loan and you may be forced to sell off your investments in a down market to start paying back that loan at an unfavorable time. Finally, interest rate risk. At the time of filming this video, the interest rate on our lines of credit are sitting at 2.95%. However, the government does actually have plans to increase this rate in the near future to help reduce inflation. When I was in medical school, I controlled for this risk by introducing a 2% interest rate stress test to my line of credit, which meant that even if interest rates were to increase 2% tomorrow, I still would not have to pay off my line of credit, or I would not reach the maximum limit on my line of credit until after my graduation from residency and I was making a staff physician's salary, which would comfortably allow me to service the interest on that line of credit. Now, that being said, if I were repeating this calculation today, I would probably use a 3% interest rate stress test rather than a 2%, given that we know that the government already has existing plans to increase rates. This can be a bit of an onerous calculation because it does involve you really sitting down and projecting out the cost of your medical degree in terms of tuition and living expenses over the next few years. But once again, for those of you that are really willing to put in the work, crunch the numbers, and leave a sizable buffer for unexpected expenses, you'll probably find that you can get by with a portion of your medical school line of credit and thus direct the remainder towards investments. Finally, once you're in residency, you can revisit this calculation because you'll be pulling in a monthly salary. So at that point, the stress test will be more so related to your ability to pay off your monthly interest expenses rather than reaching the limit on your line of credit prior to graduation. So this is essentially the calculator that I would use if I was performing this type of investing in medical school today. This is the calculator I would use to perform an interest rate stress test. Now, I'll leave a link to this calculator in the description box below, which will take you to a form where you can sign up, and I will very quickly, using an automation of course, email you this template to your email where you'll be able to download it with just a couple clicks. So let's walk you through this calculator here, as well as the limitations of this calculator and the things that you'll need to consider in addition to what I've outlined here. So of course, looking at the legend here, everything in yellow is a variable field, and everything else will sort of just adjust as you change the variable fields. If you're interested, I do recommend double clicking on some of the cells to see where these formulas are coming from. That'll just help you understand why the numbers are the way they are, rather than just going based on the calculator itself. But of course here we've used 10% for our projected stock market growth rate, 5.95% for the projected annual interest rate. Once again, that's that 3% stress test, because today our lines of credit are sitting at 2.95%. So we add 3% to stress our finances, to perform that stress test to make sure that our finances can hold up even if interest rates were to increase 3%. That's what's meant by a stress test. And of course, in this example, we're assuming that you're interested in borrowing 10K to invest in the stock market. So I'll actually take you over here first to the right, where you can see I've outlined it by month. So every month, of course, you have an interest expense associated with the principal that you borrowed. That would be the principal times your monthly interest rate plus well, that's in the first month. In the second month, you have to add the interest accrued because it compounds that way. So the second month will be the principal borrowed plus the interest accrued, then multiply that sum by the annual interest rate. And of course, you get all those outlined there. So here I've summarized, this is probably what you're more interested in, the projections at the end of years 1 to 10 in terms of how much total interest expense you've accumulated, the total investment debt, so how much your line of credit will have grown by nature of having a balance on it and having that interest accumulating month by month, the size of your investment, so of course however much you had multiplied by the projected stock market growth rate, and then your net profit, so how much you can expect to make after hypothetically selling off your investment and paying off the debt when all is said and done. So of course, once again, these numbers will change depending on what you plug in for your assumptions. And of course, the limit that I would add here is that this number right here is only considering the principal that you're considering borrowing to fund your stock market investment. I'm not considering here how much you need for your personal use. So you'll, of course, before you invest, you'll have to determine how much you need for your personal use, and make sure you do a similar calculation along these lines to make sure that, let's say, for example, you do 4 years of med school, a 5-year residency, and a 1-year fellowship. That'll be 10 years. You need to make sure that your total investment debt and your total personal debt would not exceed the limit on your line of credit, because of course that would have to force you to start paying back that money. And of course we don't want to do that in medical school. You can sort of make this assumption that, oh yeah, I'm going to draw a salary in PGY1, but in my opinion that's being a little bit aggressive, because you're projecting based on your future income that you're not even making yet. Although technically you can make the argument to make the calculation work that way as well. Now, of course, here, if you're a resident, this does start to change, because I'm assuming if you're a resident, you'd be paying off that monthly interest expense with your monthly salary and not allowing it to accrue. So rather than the stress test being reaching the limit on your line of credit with your personal and investment lines combined, you would have to consider your ability to pay off this monthly interest expense of, let's say, $50. And so this is where I'll take you to my budget template, which is just the second sheet over. And here, I'll just get you to narrow in for a second. Of course, just focusing on the monthly column here, you'll see that I've included the gross inflows, as well as your income tax deductions, as well as the CPP and disability and payroll dues and all of that. So once again, after all of your personal expenses here, so that's everything above the line of credit interest, right? Your net outflows would be added up and subtracted from your after-tax net inflows. So that's essentially your monthly salary, and that will give you your monthly unallocated cash flow, right? So with the monthly unallocated cash flow, you can then determine, okay, in this example, this isn't my personal budget, but this is a budget that I just made for the purpose of this video. In this example, this resident has like $1,200 left over at the end of the month before accounting for the interest on their line of credit. So the answer is yes, they can absolutely afford to pay $50 in interest a month and service the debt associated with this investment, even if interest rates were to rise to approximately 6%. So in this situation, yes, this resident can absolutely afford to invest that 10K, because they know that they can service that debt with a comfortable margin of safety of about 12K, even if they were to choose. Now, of course, I'll walk you through a little bit about how this budget thing works here too, in that you have to be really confident that you've actually captured all the expenses that you have to pay for on a month-to-month basis, right? So all of your professional dues, all of your family and living, your luxuries, recurring bills, transportation, everything has to be included there, because if you miss a major expense, then this whole calculation is void. The way I've set it up to work is that, of course, the yellow is, again, variable field. And the reason that some expenses are sort of amortized rather than actual is that they only come up once a year. So you can account for that by dividing the yearly expense by 12, which will give you the amortized monthly expense. And of course, that's what we're looking at here when we add up all these monthly expenses to come up with your unallocated cash flow. If you found this video helpful, do make sure to hit the subscribe button. Once again, link in the description box where you can sign up for my monthly email newsletter, as well as download a copy of the interest rate stress test calculator that will allow you to make sure that you're on top of your finances before diving into a really difficult decision like this. Once again, if you guys have any questions, do feel free to leave them in the comment section below. I know this can be a really difficult topic to wrap your head around, and I tried to make it as concise as possible, but I'm guessing that there are probably going to be a ton of questions that are popping up in your guys' head right now. So do leave a comment below, hit the subscribe button, and I look forward to seeing you guys in the next video.